Hi, this is Michael Regan with Regan Team Home Loans, and this is your update for Wednesday, August 19th, 2026. First, we're going to start with the home builder sentiment, and this report polls builders about what they're actually seeing on the ground in terms of how many people are looking at homes. What kind of sentiment do they have right now? And anything under 50, negative, anything over 50, positive. So current sales expectations of 39. Future 43, buyer traffic 23. So basically, August wasn't a great month for new home builders. They weren't seeing a lot of inventory now, or at least a lot of interest. And now this is not uncommon for August because a lot of families taking vacations last minute before school starts. It's not necessarily the best month to get a great reading because most people are out doing other things right now. Now to the new home construction report for July, and it showed that a very kind of interesting market where you did have permits up 3.1%, but starts were down 13.5%, construction was down 6% year over year, and completions are down a whopping 16.8% year over year. So realistically, with the elevated rate environment due to the Iran conflict and oil going up, what's happened is rates have become elevated, and so home builders are slowing down constructing new homes. And what this is going to do is you still have household formations, but they're not going to build enough homes to keep up with normal household formation. So that's going to be really good for you buying a house now and for those who own a house now, because there's going to be a continuation of lack of supply overall, especially whenever the market heats up again. And then in the pending home sales index, so the pending home sales showed that pending home sales were down 2.3% month over month, and they're down 2.2% year over year. And again, this is mainly attributed to the rise of interest rates. Came into this year, interest rates were getting a lot better. You saw a ton of activity. Rates have gone up. You also have a lot of uneasiness with what's going on with the Iran war and around the world. And so with that, that's not necessarily a lot of people are going to stay on the sideline. Now, this isn't the time to stay on the sideline. This is where you get in, because if rates do come down at some point, that's when everyone comes out of the woodwork and all of a sudden you have overbidding of homes and all that kind of stuff. So it's one of those things you always like to get in before the whole rush, and this would be a great opportunity to do so right now. Now to my earlier comment that builders aren't even keeping up with household formations. So how household formations show the demand in housing. And right now, as of May of 2026, we're at 1.4 million formations are happening. And you always see a dip when interest rates go way up, which we had in 25. You'll see that all of a sudden formations will go down. So they're very interest rate dependent. But right now we're at 1.4 million. What we saw earlier, that builders were only building 1.2 million. And you're going to see because of that, we're building less than the household formations, meaning that long term, we're going to have a supply shortage, which again will push house prices to keep getting more expensive because builders aren't keeping up with just what they need to every single year to keep up with household formations. And now we'll check on what the market's doing today. Right now, the Fannie Mae 30-year fix is up 19 basis points, and you'll see the chart. Red is bad for rates, green is good. And we've been really stuck in this range for quite some time. But today, rates are better because the U.S. Treasury announced that they're going to be buying more of their own treasuries, essentially a buyback program. What they've been doing is the U.S. has a lot of debt. And to fund that debt, they issue treasuries so that pension funds, retirement accounts, other countries buy our debt. What's happening is the Treasury has been buying some of our own treasuries, and they're going to up that at least through November 4th to 5.5 billion a month. So essentially, they're doing a very small version of quantitative easing, and they're buying more long-term treasuries. So the bond market really liked that because typically when they do QE, so quantitative easing, you'll see mortgage interest rates get better. Now, it depends how much they do, but at 5.5 billion, it's kind of a drop in the bucket compared to what it has been in the past. But nonetheless, they did announce that this morning, and so bond market has done better. We'll see what happens if that really has a long-term effect, but nonetheless, that is why the market is up today. And that's it for this week's update. Don't forget, we specialize in reverse home loans for seniors and bank statement loans for investors and self-employed business owners. Have a great week.